Well, folks, the markets have been quite a show lately, haven't they? Up, down, sideways. It's enough to make anyone dizzy.
A bit of a roller coaster, that's for sure.
You've all sent us a ton of stuff to sort through, too. Market analysis, news on individual stocks, even some interesting chatter from social media.
Trying to make sense of it all can be overwhelming.
Exactly. So that's where this deep dive comes in. We're going to break down the key takeaways from all these sources so you can, well, hopefully avoid getting whiplash.
Sounds like a plan.
So let's kick things off with the big picture. The overall market landscape.
Mm-hmm.
You know, the Santa Claus rally we were all hoping for, it didn't really show up, did it?
No, not quite the holiday gift we were hoping for.
Does that tell us anything
Yeah,
about investor sentiment going into 2025, I mean?
could be. Definitely raises some questions about the market's, well, strength. Especially after that mega cap-driven rally we saw in 2024.
Right. Mega caps, those huge companies, Apple, Microsoft, the usual suspects. They've been leading the charge for a while now.
Exactly. But what's interesting is that even with bond yields going up, growth stocks are still holding their own.
So could we be seeing a shift? You know, that rotation everyone talks about.
Possibly.
Just to be clear, for anyone listening who's not familiar with the term, rotation basically means investors moving their money from one asset class to another.
Right, like out of growth stocks and into something else.
So if the market broadens, moves beyond those mega caps, what kind of opportunities might we see?
Well, one of the things you sent over was an interesting piece from Morgan Stanley, analyst named Mike Wilson.
Oh, yeah, I saw that. He's been pretty cautious about this rally, hasn't he?
He has. He really emphasizes the importance of market breadth, meaning we need to see gains across a wider range of companies, not just concentrated in those tech giants.
Yeah, I remember he's been saying that the earnings recovery has been pretty narrow so far, fueled by those mega cap tech companies cutting costs and a few hot themes like AI. But the market keeps chugging along.
It does.
How do we reconcile his caution with what we're actually seeing?
Good question. Wilson suggests that the gains haven't been as widespread as they appear. He thinks we need broader participation for this rally to be sustainable.
Interesting.
And get this, he's actually recommending holding cash right now.
Cash. Really? That seems counterintuitive in a market that's going up. Why is cash suddenly so attractive just because interest rates are higher?
Higher rates definitely play a part. Short-term rates are around 4 or 5% now, so you're actually getting a decent return for very little risk compared to a couple of years ago when it was practically nothing.
True. But it's got to be more than just that, right?
Right. Cash gives you flexibility and buying power if the market does pull back.
Makes sense. Having some cash on hand means you're ready to jump in if there's a dip. All right, so moving beyond those mega caps, are there any particular themes emerging as we head into 2025?
It seems like last year's hot themes are making a comeback. Quantum computing, space exploration, nuclear energy, drones, they're all seeing renewed interest.
A theme revival, huh? Why do you think these themes are back in the spotlight? Are investors just chasing past performance?
There's definitely a psychological element there. Investors tend to flock to what's been working, right? But remember, these are high volatility plays. Big potential rewards, but also big risks.
Right, got to be careful with those.
Absolutely. Thorough research is crucial. Understanding the risks is key. You sent over that clip from the Benzinga show where they were discussing the quantum ETF, ticker QQTM.
Oh, yeah, that one's been pretty wild lately.
Its recent volume is explosive, which, indicates both big gains and substantial risks.
So proceed with caution when it comes to theme investing.
Absolutely.
Now, let's zoom in on a specific company that's, well, let's be honest, always in the headlines, Tesla. Their recent delivery numbers were a bit of a disappointment, weren't they?
A bit.
Yet that the stock bounced back.
Yeah.
What's driving that resilience?
Well, Tesla strategically released news about their energy storage deployments. Reached a new high in the last quarter. It kind of shifted the narrative away from those less than stellar delivery numbers.
Do you think that was a calculated move? To offset the negative news, I mean?
It's certainly possible. Companies know how to play the game, right, with press releases and all that, and it seems to have worked.
Interesting. Anything else at play here?
Well, there's also the technical aspect to consider. You highlighted that segment from Trading Made Simple where Sandy pointed out a potential breakout on the hourly chart if Tesla can break above $398.
So investors should keep a close eye on that $398 level.
Definitely. Could be a sign of things to come.
All right, let's move on to a company with a very different story. Carvana. This one's a real head scratcher. It's become like a battleground stock. You've got this Meme stock energy, potential short squeeze, and then boom, a really critical short report from Hindenburg Research. Can you unpack this one for us?
Carvana, ticker CVNA, has attracted a lot of short sellers. Basically, they're betting that the stock price will go down. And Hindenburg Research, they're known for their short-selling reports. They just released one accusing Carvana of misleading investors.
But then the stock went up after the report came out. What happened there?
That's the short squeeze. If enough people start buying the stock, it forces those short sellers to cover their positions, which drives the price up even further. It creates a kind of feedback loop.
So how do we make sense of this situation? It's like a tug of war between those who believe in Carvana and those who are betting against it.
Exactly. It's crucial to look at both the fundamentals of the business, is there real value there, and the technical factors. Are there signs of a potential short squeeze?
You flag some options analysis from Annery, who sees opportunity in a put butterfly or an iron condor, even with that Hindenburg report. For those who aren't familiar with options, can you explain what those strategies involve?
Sure. Options are financial instruments that give you the right, but not the obligation, to buy or sell an asset at a specific price within a certain time frame. A put butterfly and an iron condor are strategies designed to profit if the stock price stays within a certain range. Annery believes Carvana's price might be volatile but remain range-bound, making those strategies potentially profitable.
Interesting. So you can use options to manage risk and potentially profit even in uncertain situations. Speaking of risk, let's talk about something that's, well, essential for any investor to understand: support and resistance levels. You shared a clip from the Benzinga show featuring Mark Petrino, that veteran trader. He gave a real masterclass on this.
Yeah, he used Lucid Motors, ticker LCID, as a great example. He showed how the recent rally in Lucid stalled, right at a former support level that had become resistance.
Now, for those who are new to technical analysis, can you break down how support level becomes resistance?
It's all about investor psychology. Imagine you bought Lucid at a certain price and then it drops. You're sitting on a loss, right? Naturally, you're hoping it'll climb back up to at least break even.
Makes sense.
If enough people share that buyer's remorse at a particular price level, they'll be placing sell orders as the stock gets close to that price. It creates a ceiling.
So it becomes like a self-fulfilling prophecy.
Yeah.
Everyone trying to get out at the same point, which prevents the price from going higher. But why would short sellers care about support and resistance levels?
That's a great question. Short sellers often look to capitalize on these psychological levels. They might increase their bets as a stock approaches resistance, hoping to profit from the expected downturn.
It's like a game of strategy, huh?
It is a tug of war between buyers and sellers, with support and resistance acting as the key battlegrounds.
All right, I think we need a break from all this market drama. Let's talk about something a little more, well, digestible.
Are you talking about the swallowable CTAT scan you sent over?
Yes. CheckCap, ticker CHK, they received a patent for an ingestible imaging capsule. Imagine no more giant tubes for a SAE scan.
It's amazing how healthcare innovation often gets overshadowed by the political debates, isn't it? This could be a game changer. Less invasive medical imaging, more accessible. The question is, will investors see it that way?
Well, we'll have to see how the market reacts, won't we?
Speaking of market reactions, we can't ignore the recent fartcoin frenzy, making headlines everywhere. Is it all just a joke, or is there something more to it?
I have to admit, it does seem a bit absurd. You even included a story about Martin Shkreli, the pharma bro, getting into a Twitter feud about it.
It started as a joke, sure, but it highlights the power and the potential danger of social media in influencing market narrative.
Right. It's not just about meme coins either.
No, not at all. The same principles apply to traditional stocks. Information or misinformation can spread so quickly, impacting investor sentiment, driving market behavior.
So it's a reminder that we need to be careful, discerning about the information we're consuming, not getting swept up in hype, or fear for that matter.
Couldn't agree more. Critical thinking, careful research, those are essential tools for navigating the market.
Well said. This has been quite a tour, hasn't it? Through some of the key market trends and events shaping things up.
Yeah, 2025 is shaping up to be another year of uncertainty, but also opportunity.
Before we wrap up this part of our deep dive, I want to leave our listeners with something to ponder. Remember that Benzinga host, the one talking about his market mentor, who's betting on the EV recovery, but not by buying Tesla directly.
The one investing in the materials companies that supply those EV manufacturers.
That's the one. He's thinking behind the thing, as they say. Instead of betting on one company, he's diversifying his risk across that whole supply chain.
It's a really clever approach, isn't it?
I think so. Instead of looking at just the flashy car, he's thinking about all the parts that make it possible. Batteries, metals, software, the whole ecosystem that supports EVs.
And that ecosystem is full of investment opportunities. Instead of putting all your eggs in one basket with a single EV maker, you can spread the risk. Invest in the companies providing the essential ingredients for those vehicles.
So for everyone listening, I'll leave you with a question. What thing are you interested in right now, and what's behind it? What are the companies, the industries that are quietly powering that trend? It's worth exploring, isn't it?
Absolutely. It's a good reminder that there's always more to learn and discover in the world of investing.
And on that note, we're going to take a quick break. We'll be back soon to continue this deep dive with even more market insights.
It is. It could be a good way to get exposure to the EV trend without taking on the risk of a single company, like Tesla.
Yeah, that's a good point. It's all about strategy, right? Finding those creative ways to position yourself in the market. But speaking of Tesla, we were talking about Mike Wilson's cautious outlook earlier, but I know you also found some different perspectives.
I did. You sent over a note from Jeremiah Buckley. He's a portfolio manager over at Janus Henderson. He's actually pretty optimistic about mega-cap growth stocks like Tesla. Thinks they could keep outperforming the market.
Really? Even after such a strong run last year, he still sees more room to grow. What's his reasoning there?
He argues that the secular growth drivers are still in play. Things like AI, software development, those long-term trends that are reshaping whole industries. And Tesla's at the forefront of a lot of them.
So maybe the talk about Tesla's demise has been a little premature.
Yeah.
But Buckley doesn't just like Tesla, right? He sees potential in other areas of the market, too.
Right. He is bullish on growth, but he also sees opportunities in some sectors that lagged last year, like capital markets. He specifically mentioned Goldman Sachs, ticker symbol GS, as a potential beneficiary if there's a recovery in IPOs and mergers and acquisitions.
Goldman Sachs, huh? They've got a bit of a, well, shall we say, controversial reputation. Why is he so optimistic about them?
Oh, they definitely have a reputation, that's for sure. But they're also one of the most profitable banks in the world. And Buckley points out that despite their strong fundamentals, they're trading at a pretty reasonable valuation compared to other companies in the financial sector.
So it's a combination of value and growth potential. I thought that was usually in either situation.
It can be. But in a market that's rotating, moving between different themes, these kinds of opportunities pop up. Buckley sees a bunch of factors converging that make Goldman Sachs attractive right now.
Interesting. So what other sectors is he bullish on? I think you mentioned something about travel.
Yeah, he's especially optimistic about the travel industry, cites strong travel data and continued growth in discretionary spending. He highlighted Royal Caribbean Cruises, ticker RCL, as a company he likes.
Cruises, huh? Haven't there been some challenges in that industry lately? I'm thinking about those recent incidents, outbreaks, negative press, all that.
There have been some bumps in the road, for sure. But Buckley argues that Royal Caribbean has done a good job differentiating their product, appealing to a wider range of people. And they recently reinstated their dividend, which could bring in those income-seeking investors.
So cruises are back on the menu. Maybe I'll book one to celebrate my next big market win.
Sounds like a fun way to celebrate. But before you pack your bags, it's worth noting that not every sector is looking so rosy. Remember all the hype around those GLP-1 obesity drugs last year?
Oh, yeah, they were supposed to be the next big thing in healthcare. What happened there?
Well, you sent over that analysis from Jared Holtz, healthcare strategist at Mizuho, and he's pretty bearish on the sector, actually called the current situation a calamity.
A calamity. That's
Yeah.
a strong word. What's making him so pessimistic?
He sees a few negative factors coming together. There's the political risk, all the debates about drug pricing, healthcare costs, pressure on companies to keep prices down. Plus, there's this wave of patent expirations coming up for a lot of the big pharma companies, which means more competition, lower profits.
So is the whole healthcare sector a no-go zone for investors right now?
Not necessarily. He does see some bright spots, especially in medical devices. He thinks that area is a little more insulated from the political stuff around drug pricing.
That's interesting. That could be good news for check cap, right?
Yeah.
And their swallowable CK scan technology.
It could. Innovation in medical devices could really attract investors, especially if it offers solutions to these pressing healthcare challenges. But you gotta remember, investors are still nervous about the sector overall. Even United Health Group, ticker UNH, they're the biggest health insurer in the U.S., their stock price has taken a hit in the last month.
What happened there? Did they accidentally deny coverage for someone's swallowable CK scan?
I doubt it. It's more about that broader political and regulatory environment. Remember that tragic thing earlier this year with the CVS CEO? That whole situation brought healthcare costs and access back into the spotlight, creates uncertainty for investors.
So yeah, it sounds like the healthcare sector is a bit of a minefield right now. Investors need to be extra careful, really selective.
That's a good way to put it. Now, let's switch gears for a minute. Let's talk about a story that really highlights the power of long-term investing. One of the articles you sent talked about how a simple $100 investment could have made you rich if you had just held on long enough.
I love those what-if scenarios. They really show you the magic of compounding. Which companies did they use as examples?
They focused on three big names: Eli Lilly, ticker LLY, John Deere, ticker DE, and Nike, ticker NKE. If you put $100 into Eli Lilly 15 years ago, you'd have over $1,600 today.
Wow, that's a 15x return on just $100. That's incredible. What drove Eli Lilly's success over that time?
They've consistently been at the forefront of pharmaceutical innovation, especially in areas like diabetes care and oncology. They're really good at developing new and effective treatments. That's been key to their growth.
That makes sense. They've definitely got a strong track record of innovation. What about John Deere? How did $100 in them do?
If you'd invested $100 5 years ago, it would be worth over $270 today. Their growth has been fueled by that increasing demand for agricultural technology, automation. Farmers are always looking for ways to be more efficient, more productive, and John Deere's been a leader in providing those solutions.
So they've benefited from that long-term trend towards more technology in agriculture. Smart play.
Yeah.
And Nike.
Mm.
I bet that one's a slam dunk.
Oh, yeah. 20 years ago, a $100 investment in Nike would be worth over $9,300 today. They've built an iconic global brand, synonymous with athletic performance, style, consistent growth, global reach. They've been a phenomenal investment.
It's almost a 100-bagger.
Yeah.
Unbelievable. So what's the takeaway here? Just buy and hold wins again?
It definitely reminds you that time and patience can be your best friends in the market. But it's not about buying and holding any stock. It's about choosing companies with that long-term growth potential, a solid track record, the ability to adapt as things change.
Right. It's not about throwing darts at a board. You got to have a strategy. Do your research. Speaking of growth potential, remember those quantum computing stocks, those high flyers we were talking about earlier? IonQ, ticker IONQ, had that incredible run at the end of last year.
Yep, and it looks like it's trying to make another move. It's up over 14% today.
Is this the start of another quantum computing boom?
It's possible. Remember what we said about volatility? These stocks can move fast in both directions. You've really got to manage your risk carefully, not get caught up in the hype.
So buckle up, everybody. Looks like 2025 is going to be another wild ride in the markets. We've got uncertainty with interest rates, the political landscape, and a whole lot of opportunity for investors who are willing to do their homework and stay focused.
Absolutely. There's a lot to process, but that's what we're here for.
That's right. We'll be back for the final part of this deep dive after a quick break. And we're back for the final part of our deep dive into all things market-related. I feel like we've covered a lot of ground, haven't we?
We have macro trends, sector outlooks, even a little bit of investor psychology.
That's right. Now, before we wrap things up completely, I want to circle back to something we touched on earlier and maybe leave you all with a bit of a thought-provoking idea to chew on.
Sounds good to me. Lay it on us.
All right. Remember those long-term investing examples? Eli Lilly, John Deere, and Nike.
Yeah, the ones where $100 turned into thousands over time.
Exactly. It's amazing to see how patience and a well-chosen stock can really pay off. It got me thinking about the power of compounding, how those small, consistent gains just snowball over time.
It's a good reminder that investing isn't always about trying to time the market perfectly or chase the next hot stock. Sometimes it's about finding those solid companies, the ones with real growth potential, and then just letting time do its thing.
Absolutely. And this brings me to that thought-provoking idea I mentioned. Remember you were talking about that market mentor, the one who's betting on the EV recovery, but not by buying Tesla directly.
The one who's investing in all the companies that supply the EV makers.
That's the one. He's thinking big picture,
Mm.
the underlying infrastructure that makes those electric vehicles possible.
A clever approach, for sure.
I think so too.
Yeah.
It's like looking beyond the flashy car and seeing all the pieces that go into making it a reality. batteries, metals, software. There's this whole ecosystem supporting that EV revolution.
And that ecosystem is full of investment opportunities. You're not putting all your eggs in one basket with a single EV maker. You're diversifying, spreading the risk across those companies that provide the essential ingredients.
Right. It's like that saying, think behind the thing, understanding the bigger forces that are driving a trend, and then finding the companies that stand to benefit.
It's a valuable lesson for any investor, really. EVs, healthcare, whatever sector you're interested in, taking the time to understand that whole value chain can open up all sorts of possibilities.
I agree. It encourages us to think a little differently, a little more creatively about our investment strategies. So for everyone listening, I'll leave you with this question. What thing are you interested in right now, and what lies behind it? What are the companies, the industries that are quietly powering that trend? It's worth taking a look, don't you think?
I do. It's a good reminder that there's always more to learn.
Couldn't have said it better myself. Well, it's been a pleasure breaking down all this market info with you today. Always appreciate your insights.
Likewise, these conversations are always stimulating.
And to everyone listening, thank you for joining us for this deep dive. Remember, knowledge is power. The more informed you are, the better equipped you'll be to navigate those market twists and turns. Until next time, happy investing, everyone.